Now looking at the NSE 20 hitting a 17-month high in yesterday's trading session. We also saw foreigners quite active in the market yesterday. So Kenya clearly is sitting in a rather positive macroeconomic environment. So we could perhaps see further gains coming through for the NSE 20.
Yes, I think there is a likelihood that the market will continue to rise over the coming months. One of the things that is noticeable about the Kenyan economy is that economic growth was quite slow in the first half of the year. The central bank is now looking to stimulate economic activity. The currency has been relatively stable, and in fact the central bank does have the capacity to stabilize the currency should excess volatility cause the currency to depreciate substantially. So in that kind of environment, I think the economic growth is going to accelerate. I think corporate earnings are going to be well supported, and the market and sentiment, not just for foreign investors but also for domestic investors as well, is likely to improve, leading to improvements in the NSE 20 as well.
With the picture that you've just painted now about economic growth going forward, which sectors should investors be looking at right now on the NSE 20?
I wouldn't like to make a recommendation. I mean, I've got colleagues who've got specific stock recommendations, but from my perspective, I think there is a likelihood that interest rates are going to remain low. There is a likelihood that as a result of that, we are going to see credit spending increasing in the economy. One of the stocks that our equity analysts like is KCB, being a very well-capitalized bank. I think in an environment where inflation is going to be low, where monetary policy is going to be focused on trying to keep interest rates as low as possible, sectors of the economy that are going to benefit from that are likely to also benefit on the NSE as well. So there are some banks that might be doing well. There are some consumer stocks or proxies for consumer spending that investors should be looking at when they're looking at the Nairobi Stock Exchange.
Now looking at the Kenyan shilling, you did touch on it a bit earlier, pretty stable at this stage, going against what we are currently seeing on the global forex market. Talk us through some of the factors that have kept the shilling quite stable at this stage. Could we perhaps see the situation change going forward?
I think the situation is unlikely to change substantially going forward. I think the currency is likely to remain relatively stable. There might be periods of extreme sell-offs because of huge demand in the market or whatever, but I don't think that is going to be sustained for long periods of time. One of the things that has happened since last year, in line with the slowdown in economic activity, we've seen that import demand has slowed down. We've seen that the current account deficit has slowed down quite significantly. We've seen that largely as a result of the improvements in the macroeconomic fundamentals. We've seen quite a lot of inflows, foreign investor inflows into the market here, and that has supported the balance of payments. FX reserves have increased quite substantially. So, in that, with that sort of background, it's very unlikely that we would see the currency coming under significant pressure. We've also seen that the central bank is quite keen on protecting the sort of 83 level, not allowing the currency to appreciate, beyond that sort of level. So we're likely to see the currency remaining relatively range bound, despite some volatility that might from time to time occur.
Well, looking at the fixed income market, we have seen a bit of a gradual move from the fixed income market through to the equity market, but it seems like things are changing now. We have a bond and treasury yields edging higher. Are we likely to see a change in dynamics here where we see a move from equities back into the fixed income space?
First of all, I don't think the increase in rates and T-bill rates and bond rates is going to be sustained. The picture that I painted earlier on to me suggests that any increase in interest rates will sort of cause investors, even if they do try to put money into fixed income and into cash, they will lead to even lower interest rates going forward. So I don't think that the move higher in interest rates is going to be sustainable. If you think about it, with the 6-month and 1-year T-bill rates above 10% right now, If you look at where inflation is, inflation was at 5.3% in September. Going forward, I expect that inflation is going to be in a range of between 5 and 7% over the course of next year. So that would mean that if you've got a 1-year T-bill, you're being paid 5% real yield. So at some point in time, investors are going to come back into the fixed income market, into the cash, and they're going to beat those rates much lower, given the fact that inflation is going to be declining. What we've been expecting is that there is going to be money actually moving out of fixed income and out of cash into equities, given the solid macroeconomic fundamentals that I was talking about earlier. So I would expect that that move, which I don't think is quite finished just yet, that move is going to occur. As it occurs, money is going to be moving into equities, and as a result of that, equities are going to outperform fixed income and cash. If anything, the volatility that we've seen in yields since about May this year do point to the relatively lackluster performance of the fixed income market and cash that's likely to occur going forward. If you're investing in a 5-year bond at 13%, over the next year, that yield is probably going to be quite volatile. Whereas if you put that money in cash, the likelihood is that you're going to be making much better money with very little volatility compared to fixed income and cash at this point.